Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Economy Show, we're going to go through some. It's a broad one, so we'll cover a lot of topics and try to dig into some different areas. The first one, we're going to look at debt to GDP. We're going to look at the vaccine. How is it moving through the system? Who has coverage? Who doesn't? And what are high frequency data points telling us? Part two is going to look at U.S. economic data. There's, retail sales had a big miss, and what does that mean as we head into potential stimulus coming out of Congress today? Then we have just looking at real estate and as well as jobs, as we had a big increase in jobless unemployment last week. And then we're going to look at Europe. And then rounding it out, we're going to go deeper into Asian data, specifically Indian exports, inflation, and then what are some of the new Chinese data points telling us. So before we get into it, we'd like to remind you we do have our end of year report available. Please reach out for more. We cover a broad amount of topics across the energy, NGL, and geopolitical space. So please reach out for a table of contents and a sample. And then again, please like, share, subscribe. Your support is appreciated. So this was a great visual chart, just kind of jumping in here in terms of the amount of or change in debt to GDP and who is issuing that debt. Who are the financial corporations, the households, the governments, and you can see Canada's taking the top spot here as Japan continues to along its way of just taking every single corporation and government entity into the BOJ, and obviously the U.S. has been a big component of that as well, as we see an additional increase in debt across the board. And you can see that it's increased everywhere. Even though we've had some reduction in debt levels at the household, this is looking from Q4 of 19 into Q3 of 2020, and we can see these increases that are continuing to happen. China is another big one, obviously, as we kind of round out that top level. And then the Euro area in general, with the government being the biggest driver, as households really haven't added all that much. It's really been driven by corporations and governments. And in part two, we're going to go through a bit more about U.S. corporations and what have they been doing. They've issued a lot of debt. What does that mean? How much of it is zombie versus not, and how is that flow going to kind of go through? So even though we've seen all of this change in debt to GDP, we have 93% of economies in recession this year. So 93% of economies are in recession. There is apparently a view that this will immediately reverse itself. You can see just how red it is in terms of a greater than 6% drop versus where we were in 07, 08, 09. You can see that we have a much bigger drop on just the severity and the amount that has fallen. But where there is a big expectation of greater than 6% next year, which again, we kind of remain fairly concerned about in terms of some of these levels that we just maybe won't see the same type of rejuvenation. Now, even though we've seen 93% of economies in recession, the first ever real or second, depending on estimates that you're using, global macro slowdown, we have risk on a global level where you can see equities, U.S. focus is 30.4%. Global equity exposure is at 19.3%. So even though we've had this big fear, this big drop in economic data and just macroeconomic shortfalls, even though the vaccine is just getting moved out, we still have some kind of wishy-washy economic drivers. It's risk on because the market is looking forward to what? We're still trying to figure that out. And not only are they putting on exposure, but they're doing it with leverage. So call options continue to be a massive mover. The biggest call options remain in the S&P 500. I know, no shocking, and Tesla, as call options remain very robust, and we continue to see the explosion. This is the 20-day moving average, so you can see that we're outpacing any time previously, and that's why we continue to see this push to the upside, because You have the brokers looking to hedge out some of their risk, which is pushing them to essentially either buy or sell equities. And at this point, they're looking to buy equities to offset, which again is increasing the overall amount of purchasing that happens in the market as the VWAP remains in place and the market remains, or I should say, the world global equity market remains at all-time highs. And now this is in light of government budgets. So government budgets continue to have a shortfall. This is looking at emerging Asia, emerging Europe, and Latin America, just because when we go through the high frequency data, we've seen some of the strength coming into the emerging markets, and we just wanted to highlight how precarious some of this is as the percentage of GDP shortfalls remain elevated, and we're starting to see a little bit of fear coming in on the inflation side, which is limiting some of the renewed some of the renewed things that are being done, or some of the new types of means of stimulating the economy as that some of that is taken away. And this just gives you an idea. So the ones to really watch are really India. India is going to be a bigger one, and then obviously it's South Africa, Brazil. So Brazil, right now, there's not too much fear on the currency side, but obviously debt remains massive, and that continues to be an issue as well in India as inflation fears have tempered a little bit, but again, still remain elevated, which is taking away some of the abilities of the central bank to continue to be resilient and to stimulate a bit more. Now, this is the GDP backdrop, but a lot of things have been placed on the vaccine, the rollout of the vaccine. It's important to, I think, appreciate where is the herd immunity and who has the most amount of vaccines available. So here you can see just the amount of inoculation as a percent of population coverage. So right now, the U.S. can inoculate, if we take delivery of all of the vaccines that we've purchased, which is obviously not only just Pfizer, as we've bought 100 million of Pfizer, 100 million of Moderna, 100 million of others, again, to give us to. So that just means that we'll be able to inoculate 153% of the U.S. Canada can do it to 410% because they overpurchased. The UK, Australia, France, you can see that they've all overbought. Now, India can then can essentially inoculate against 85% of their population. Then we start going into protect the vulnerable. And let me just preface this. The scientific research states that if you have 80% or more of your population that are immune to a disease, you have achieved herd immunity. So even though 85% obviously means that not everybody will be immunized, it just means that you have reached herd immunity, same with South Korea. Now, when we look at protect the vulnerable, it's important to look at who has what. Now, China has claimed their own vaccines, which we've highlighted in other shows, and based on what they're saying is they have enough for 12%. This is an interesting thing because obviously they've been very good at trying to manage their exposures, but 12%, if you think about trying to get back to normal with normal flights and normal movements, this is going to be a concern, especially as you get to just being able to protect the vulnerable. How can we get back to business if you have so few people that are immunized? And this is where we kind of come to, well, how do we get back to normal? How quickly can these vaccines get rolled out? What do the logistics look like? What is the speed in which it can happen and operate, which again is an overarching problem. And then just looking at it a little differently, vaccine coverage as a percentage of population, you can see kind of that waterfall and that drawdown, and you want to be 80% or more in terms of having that coverage, and you want to space it out because if something's delayed, then you'll disseminate more of another, and this is where we start to kind of get these pushbacks in terms of timing. Now it comes to getting it through North America. So let's just look at North America. January, we had a cut. So we're closer to the pessimistic case percentage on just based on how this was developed by Oxford Economics. And you can see the amount of doses and the population being vaccinated. So the base case is about 60% of the population vaccinated by June. we've already seen delays on the Pfizer side, which is delayed to us, full logistical movements until June, July. That's looking at New York on a state level. So some of these, again, there's a lot of logistics involved. There's a lot of, do people want it? Can they take it? Are there any hiccups? Are we making enough? Do we have enough, coming back? Or did some of them go bad in transit? And those have to be thrown out and replaced. There's a lot of things that come into it, but you can see that just based on the base case, in the worst case scenario, the pessimistic case, at least 40 to 50% of the population will be vaccinated by June is the estimate. Again, at what point do people feel better about going out? That's always going to kind of be the unknown, and that's really looking at consumer behaviors. Will you get a vaccine and immediately book a trip to France to go move around Paris for a week? I don't know. Do people have the jobs or the discretionary income to do that? Again, these are things that we have to kind of look at in terms of some of this normalization, which is why we remain concerned on what does GDP growth look like really in 2021 based on the dissemination of this vaccine. But upside risk is there, and everybody is you can see in terms of how many people are expecting a downside adjustment to GDP has fallen as the vaccines get announced. Now only 20% really think that there's going to be an adjustment to the downside, and let's say about 60% or 50% think that there's going to be upside movement. Again, there's a lot of uncertainty in terms of vaccine movement. When is this going to go? And that is going to put some pressure in terms of kind of how quickly do we get the vaccine? How quickly do we get GDP growth? And how quickly do we get jobs starting to normalize, which is going to be kind of pivotal to getting us back to some sort of normalcy, because jobs continue to be that overhang that we're looking at. Now, given it's a lagging indicator, but given the rapid move, or I should say the rapid adjustment in the market to lay people off, to furlough, people going from furloughed to permanently unemployed, again, these are things that are becoming a bigger issue, which is why global mobility indices on the OECD level continue to drift lower. Global mobility indices on non-OECD continue to kind of trend up. And this is the kind of tale of two cities, because as OECD slows down, then they're buyers from emerging markets, which are non-OECD countries for the most part, and that's where we're starting to kind of get this movement where it's not that the non-OECDs are going to turn down; it's that it's just going to wait on them going forward and limit their abilities to really see a normalization of growth as we continue to see some of these things move lower. North America is the biggest issue as we continue to talk about. But now we've talked about mobility as linking us back to the EIA as we look at refined product demand, which is why we remain concerned on refined product demand and just how does that lead to oil demand overall. But now let's look at daily economic indicators or activity indicators. And you can see that we've had a strong bounce from France, which is normalizing, come down a bit. But where everything is clustering within this 70 to 75%, and just given the size of the economy sitting there and shifting down and getting a little bit worse, the U.S. economic data has shifted down a little bit, even as cases kind of stay fairly flat. And this is going to continue to put pressure on the market overall as that continues to shift. Spain is now falling back down. Germany continues to fall back to see some pressure and kind of flatline. So these are going to be the bigger problems as we head into the new year. Now, China has started to fall back a little bit. Again, we'll talk about some of the economic data points that we want to highlight in the last segment, because some of this looks to be kind of overblown. But again, we'll go through that in pieces. But as we keep talking about, the daily activity indicators have stopped going up. They've gone sideways, and that's really coming full circle to the emerging markets being impacted based on the advanced economies not really seeing that kind of robust nature, and then that bounce back and actually starting to slow down, go back into lockdowns, which is again going to hurt exports coming from emerging markets. India has gradually gotten worse from the high of November. That's going to continue based on some of the data points that we're going to talk about in the last segment. And you're seeing that we're capped now a little bit higher, but closer to that, 77 to 80%, which is being reflected in this, where advanced economies have flattened out, but again, acted as a weight and pulling things back down to average closer to, 77 to that 80%. Now, when we look at short-term slowdowns, this is the, fun with the alphabet of V shape, swoosh shape, U shape, W shape. Yeah, it's people like to come up with different things. Now, the swoosh it was always my favorite, but it was always the one that we thought was the most likely. The question was always going to be slope. And that's where, what is the slope of the normalization of getting back to some sort of growth? And we just think it's going to, it's going to be deeper than expected, as we talked about, but the bounce back won't be as quick, and the slope will disappoint, which again is going to kind of weigh on how quickly do we get back to some sort of normalcy. And again, vaccinations have kind of lifted that outlook. We remain reserved in terms of the logistics, just because our jobs are logistics and we know how difficult they can be. Obviously, there is a huge push to have this go well, but again, these are things that are of caution. W has increased as we've seen Europe and US slow down. We think that instead of it being more of a W, it'll just adjust the slope over time, which is why the swoosh, if you will, remains kind of how we think this is going to look going forward. And speaking of which, Bloomberg Economics put together this great chart looking at, okay, well, where are we if we get no aid? And you can see that kind of drop down, because we've seen retail sales, which we'll talk about later on, those disappointed to the downside, missing estimates, which just means that you're getting some pressure, because November is typically a big buying period, especially as people were purchasing ahead of Christmas. And the assessment of what does stimulus look like. So this is looking at $908 billion. That we're going to get slowdown into 2021. The question is going to be, how big is the slowdown? And this is looking at $748 billion package, no state and local aid, $908 billion, which is, I think, the base case at this point, just based on commentary we've seen. $908 billion, including state and local aid, is the most likely. But again, it's just going to be a matter of how do people treat that, and we're still just going to see this flatlining nature. And I'm not as convinced personally, in terms of the data that we look at, the people that we talk to, that we'll see this gradual trend. It's more along of a kind of a flatness through Q1, Q2, and then as we get into Q3, starting to see some of this curl to the upside. Again, who is expecting what? Wall Street banks, in terms of the economy expanding. You can see where people sit on 2021 in terms of the expansion, with the most lofty being above 6%. We're closer to this, let's call it 3.5% to 4%. And it's really going to be, I always hate saying the term, but back half weighted, because we think that there's going to be a lot of pressure in Q1 and Q2. As consumer behavior is impacted in terms of people willing to do a lot, and as well as people just not having the capital to do it. When we talk about lower to lower middle income being impacted the most, seeing the biggest impact to jobs, which just aren't going to snap back, which is going to just weigh on total economic activity. But whether you like it or not, the combined balance sheet of the Fed, BOJ, and ECB were at $22.5 trillion, all-time highs. Keeping it going. Total assets have risen by $8 trillion, which is equal to the combined GDP of Japan and India. So we're still out there. The question is, how does it get into the system? Because we're not seeing the flow down as it just sits at the bank or at the Fed, depending on how quickly it gets pulled down to the bank. And we're still not seeing those loans being turned back out, which again is limiting those dollars moving through the system. Then we look at U.S. Treasury maturity schedule. So, we had about $1 trillion worth of treasuries that have been matured in 2020. Due to us issuing a significant amount of treasuries, not only will we have to issue more treasuries to cover our deficit, but we'll also have to roll treasuries of $5.8 trillion. And this is where where we continue to talk about how debt is going to sit and slow us down and act as a massive headwind to GDP growth. Because not only are we going to expand the amount of treasuries in 2021, we have to roll more treasuries in 2021 than ever before. Again, this is just becoming this perpetual motion of just issuing more and more treasuries, because this gets rolled and the budget shortfall increases. So then each year we're going to see more and more treasuries. So not only in 2022 is there 2.5 trillion expiring, but we're also going to have to roll 5.8 plus fill the gap. And obviously you can see how this gets out of hand very quickly, which is why when we look at US federal debt and then net interest expense is going to continue to go higher over time. It initially comes down because why does it come down? Because obviously interest rates are free. So interest expense comes down, but then the sheer size of the interest that has to be paid just becomes overwhelming, even though it's less. And by less, instead of having to pay, let's call it 2%, I'm paying 1%, but I have to pay 1% on 200 times the amount of principal that I initially did. You can see how quickly this gets out of hand, which is why we have interest expense going parabolic, weighing on total economic activity. Again, these are reasons why debt is going to be a big overhang, because this isn't just at the government level. This is at the corporate level as well. And given how soft rates have been, people have been very quick to issue new debt. It's coming in fairly tight. And now it's a matter of, well, how do we pay back this debt as zombie companies continue to grow? And the likelihood of them staying as zombie companies, which is just no income growth, is only increasing over time. And now we're going to go into, in the next segment, retail sales and what does this mean for kind of the broader economic backdrop as we go into not only the end of this year, but into next year.